OPK, OPKO Health. They are a company running a Rona therapeutic called Rayaldee, and nothing has changed, honestly, since when we looked at it last maybe September. They're still in their phase 2, 160 participants. Before, it was supposed to be done in February. Now they've pushed the completion date to May. So no news there, but just trying to do kind of a review. What I wanted to do in this video was a DCF. I had collected already a bunch of the numbers, and I put it in an older video, and a lot of people watched it, and it got only thumbs up and no thumbs down. And I thought, well, today we're here at $4.47, right at the support area. Not only that, I had someone ask me, okay, the bond yields are going up. Investing in bonds is not very attractive. If the interest rates continue to go up, like Rayaldee talks about, initially it's bad for bonds, but then after that, it's bad for stocks. So how to play it? And I was like, well, that is, what everyone is trying to figure out, is it not? A lot of red this week. And so again, OPKO is interesting because, it has progressed upwards, and they had a lot of people, their insiders bought anywhere from like this $3 to maybe like $3.70 range. So now we're up at $4.47. I can show you that here in a second, but I'll leave this here. The really interesting thing with this is, one, there's this company called Syrian Capital, who is a pretty large stakeholder. I don't know how large, I can't remember, but the point is that they put out a number of different papers and a number of different analyses, and they've said, A, this company is terribly mismanaged, which is true. They say if the profit margin on their core business was like Quest or like LabCorp, who have profit margins around 27%. OPKO only has a 10% profit margin. So they said, look, if you could just bring that up a little bit, that would really help shareholders out. Syrian has always been gunning for them for acquisition. So I don't know how likely that is, but there's two interesting things, I think, in that regard. Here's a lot of the folks buying anywhere. This goes back, where is the date? March, April 17th. So recently, 391, 477. Anyway, so a lot of insider buying is basically the point, right? And so why is that? This is mostly, actually, this is all just their CEO, Philip Frost. So he just keeps buying and buying this thing. And so let's jump over to this DCF. So it's not the most, academic. It's a little bit dirty as far as, but I'll walk you through it. And since the price per share, 483, I thought, okay, I'll just stop here. This is a ballpark number, and we'll look at some of the assumptions. But what we're basically doing is 2020 is over. We have 3 years of growth, and we'll say in the 2024, we'll call that the terminal year. And I'm just going to walk you line by line. We know that BRL, BioReference Lab, is the large majority, something like 80% of their entire business. Yes, they do some veterinary stuff. Yes, they have some royalties. Yes, they do have some drug sales, but it's a very small percent of their overall business. They're basically it's all wrapped up in BioReference Lab, which many of us have heard from them about, like NBA, NHL, doing a lot of testing in New York, getting a lot of contracts with schools. So I'll just walk through it. Generally, what we're going to do is we're going to take a bunch of information here in this note section from the report that we got from the older video. I'll put just a thumbnail of that up really quick so you know what I'm talking about. And I tried to put the timestamps on there when I could, but basically the BRL, Syrian Capital analysis stuff starts somewhere around the 20-minute mark and then goes from about 20 to 25. Anyways, they say that it's reasonable to think that the company core business should have about a 10 to 15% long-term growth rates, and that was taken from their Syrian Capital response letter. So what I did was Syrian's growth rate declining into maturity for the company. So 12, 11, 11, 7%, and then 5% growth rate at maturity. Okay, these are the assumptions. And they always matter. If you've played around with these DCF models, the assumptions matter a lot. The growth rate, the WACC, or you could maybe have heard of it called the discount rate, whatever. But so these are the assumptions. So then we have the molecular test and the antigen test. I'm just taking the numbers off the video that we already looked at before. We know the price per unit is $100 is what they were charging last year. That could have gone up, but we have different journalists that have already given us these numbers. I pulled it, like I said, so just check out the video. And then they were doing their quantity last year, so 8.8 million a year. And I just kept these numbers static. And what I did is at the bottom line, I applied these growth rates. So that's why you're going to see the same numbers. It's going to be the same number across. And then we'll apply, like I said, the growth rate at the bottom. Antigen test. This was really interesting. The investor presentation said that they could run 144 million tests a year. That's at 13 minutes, 36 seconds. And they are running, so 144 million a year capacity. They were running 2 million a year in 2020. Now, the pandemic started midway through the year, and they didn't totally ramp up and blah 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 blah. But this is what 72 times extra capacity that they have. 144 divided by 2, right? So that's a ton of capacity extra that they have on the antigen side of things. Antigen tests, we knew that they were charging $55. That might have gone up. There has been other, whatever, competitors. A lot of interesting stuff. Like, who was it? So Abbott Labs was doing one for $5. That was retail price for $5. So maybe these are, I don't know. There's a lot of companies, see like T2 Biosystems, and other people. So a lot of these companies that are trying to do these saliva tests, saliva collection, you have to send those off. Anyways, I'm not going to get into all that, but we got this from the Motley Fool, July 13th article, 2020. The author was O'Reilly, I believe is how you'd say his name. Anyway, so we're just taking the price times the quantity. Very simple stuff. Very, freshman, sophomore year of college, business type stuff. Here we have the royalties from Pfizer's previous HGH. So OPA is getting 20% of the Pfizer drug that has revenues of $500 million a year. So 20% on $500 million is $100 million a year across the board. And then if you look at the video, about 24 minutes that I did, the royalties for OPKO's HGH is also going to bring in about $100 million a year. They told us straight up that they estimated that. Just, you can combine it. There's a sentence in there at 24 minutes and 4 seconds that states that Sion's annual profit stream from the HGH royalties combined would be about $200 million a year. So just put it right there. Just put it in there. Finally, we see that BRL has a profit margin that's been 10%. And that's what a lot of the authors, whether from Sion or otherwise, have really criticized. OPKO Health Bioreference Lab, they said, man, they're, and even me, I'm looking at it, I'm like, their margins are just, what is their deal? So currently I calculated it at a 10% margin rate, and you can see that number right here. And so I'm going to change that in the future. But Sion thinks, well, man, Quest and, like we said, LabCorp have a profit margin of about 27%. So if these people could get on board, either if it was better managed or if there was a takeover and someone could just, cut some of the fat off and improve some of the steps, even if they could get, say, like, I don't know, we can run the numbers, so we can play around with this, and we will in a minute. But you have all the revenues from that, the profit margin. This is from the testing, so molecular and antigen testing with profits at 10%. You know that the profit margin is going to go on the top line of the cash flow. So like I said, I'm not adjusting it from there for different capital expenditures or other things like this. But that's why I say it's a little bit raw, a little bit dirty. But I stopped because you're basically just trying to find with these models a direction. Do you think, based on these different assumptions, the price is going to go higher or lower? That's really all you're trying to do. It's not an exact science because these are a lot of things. Look, what's going to be the interest rate in 2021, 2022, 2023, 2024? Like, I don't know, and so I'll show you where I got the WACC, but the discount rate again. But so anyway, let's just start in the beginning with a 10% profit margin, and that'll give us the $99 million a year from that segment. So then we're just adding these together, the blue 200 million plus the 99 million times the growth rate that we have. So that's the 11% growth rate from the previous year. So we're just gonna, that takes us to the 331 million. I hope you guys can see this. I'll try to zoom it in when I get there later. I'll go back actually. So anyways, this is the growth rate here. And again, the growth rate I assume, since they said between 10 and 15% long-term growth rate is reasonable, I did 12%, 11%, 11%, 7%, and internal growth at 5%. So you could argue with any of those numbers, and I'll post this in the file section of Premier Studying and Investing. We have a, I'll post it in the the name of the Facebook group that we have is Smart Money Investing. I'll leave a link for it. I always leave a link for it. So anyways, so we have our cash flow combined from the royalties and from the testing. Then what we do is we apply weighted average cost of capital, and I'm going to say that it increases. So I'll show you where I pulled this from. This is from Finbox.com, NASDAQ, OPKO models, the WACC. They say a low WACC is 8.2%, mid is 9%, and a high would be 10.2%. So weighted average cost of capital, it takes a little bit of work. You have to find the unleveraged beta and then re-leverage it, and then find the cost of equity, and then the cost of capital, and then how much equity do they hold, and then how much of the funding comes from debt, and all of this and that. So it's I'm not gonna go through all that. I could, but we'll go with them. We'll go with theirs. They give you a nice the debt cost of debt, the debt and equity weights, the weighted averages, and they show you how they calculate everything, the beta that they use, and all that. So they give us a range 8.2 to 10.2. Okay. So since they said that the 9.4% WACC was, reasonable, I think the cost of debt is going to become more expensive, and so I increased it from 9.4% to 10% to 11%, and terminal WACC was 12%. So I really think that all this money printing is going to increase. I hope not more than that, but it could, and that would be a huge change. So like I said, I'll put it in the files. You can open it. You can change all the different assumptions and variables and see what you think. But like I said, once it got to we're trading at somewhere like 460 today. So once it was at like 483, I was like, okay, this is probably pretty decent estimate. What we did was we just took those rates and we compounded them to the future. So we have year 1, 2, and 3. So this is just pretty simple stuff. If you're familiar with DCF, you're just taking the WACC, you're adding 1 to it, and you're raising it to the year that you're in. So just the blue 1 plus 1 raised to the number of years that you have to discount back. So this is year 2, year 3. And then anyway, so we're just going to sum these up. We're going to get the terminal value. We're going to get the present value of all the growth years here in green, plus the terminal value year here. And then there's about 640 million shares outstanding, giving us the price of 483. So now what's really interesting is, since all of this has been documented, and I showed you where I got the discount rate, which is hugely important. I showed you why I picked the growth rates, and I don't have a great reason for the terminal growth rate, but 5%. I don't think that they're going to be done growing basically in 2024. I think this company has a lot of time, but I don't like doing DCFs over like 10 years into the future because there's too much that can happen macroeconomically and debt cycles and all that stuff. So I just called it at 2004. Now, the big point here is, like we said, of course, you could have the acquisition. But what if we change this profit margin to, it was at 10%. Let's just go a nice easy number. Let's raise the profit margin to 15%. So say someone can do this a little bit more efficiently. The value per share raises to $5.63. Now, LabCorp and Quest are running 27%. So let's go one more. Let's go up to 20% profit margin. I think that's not that crazy. Of course, we don't know all the ins and the outs of all three of the businesses, but at a 20% profit margin, shares are $6.43 a share. And then if they could go 25%, 723. So 723 on where are we at? I mean, let's just do something really easy. Like, what is 7 on, say, like, where are we at? 465 today. So it's a 50% increase. Now, usually when companies are bought out, they're bought out at a premium. 50% premium would be pretty sweet. Additionally, you may be able to get even something better than that if a new company was to be able to come in. Maybe a private equity firm could come in. I mean, because this isn't a huge firm in terms of market cap. No, it's a $3 billion company on the market cap. So it's definitely possible that someone could come in and scoop this up. We know that Scion Capital is probably on the phone with people right now trying to find somebody to buy this thing. So I just thought the DCF was interesting. It's something I've been wanting to do. I've definitely been thinking, how to play this with the increasing rates in the market, the 10-year, the 5-year break-even inflation. And the big thing that really is so concerning is, they're going to obviously try to run vaccines like crazy, hoping to get people back to work. But if the jobless claims continue to increase, I don't see for the average stock anything that is going to be all that promising. You're looking, or I'm looking for something that would do well. Amazon maybe has done really, really well during the pandemic because everyone wants to order in stuff. This is another possibility. It's healthcare, it's testing. We know that demand is large from the requests we've seen from other companies like Quidel, I always say their name wrong, and others. There's a lot of testing, the Biden administration. It depends, if you look at Brazil, if you look at the new strains, South Africa, British, all this stuff. This is going to be, I'd say, priority number one for every government, right? How do we get this thing under control? How do we, get our people back to work? How do we build confidence in our investors and in our entrepreneurs to expand? How do we avoid stagflation with a shift left in the supply curve? So, this is my take. That's all I have. Thanks so much. Well, yes, stop by. It's Smart Money Investing on Facebook. And that's where you can find this. We're starving artists here. Please give us a share, give us a thumbs up. If it's helpful, even if you decide not to invest, or if you do, it'd be very interesting to say, leave us a comment and say, well, this is why I didn't, or this is why I did, and this is my buying strategy. Thanks, everyone.